Hey traders, happy Sunday. This is Ron Haydat, Market Tamer. Hope you're having a fantastic weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk and specific financial issues. Should always be addressed with your financial advisor. We'll start off with daily charts, then we're going to do weeklies on the majors because support is breaking. In some cases, it's just a little, others it's cut and dry. So first up, the S&P 500 ETF SPY. We closed at 275.27. You can see by the 200-day here, the last price is 275.48. It's 21 cents, but it is what it is, and it is a break. If I switch here to the SPX, you can see with Friday's move, it clearly violated, closed below. In fact, we gapped below, never even came back to test it. There was never really an attempt to get back above it, and then closed near the lows of the day. This is a breakdown. Bulls have lost their edge. We talked about the red line, which is the 20-day EMA. You can see by up here what they are. The orange is an institutional moving average, the 50-day. When a shorter term crosses below a longer term, that is a technical sell signal. So this has already been warning things are not looking good, and today was the last hope of the bulls. It's been broken. Now the bulls could come around and say, on the SPX, well, hey, there's this little swing low from March 8th, that little dip. That was a one-day dip. It's not like there was a major hammer, or if I go to the SPY on that day, if I zoom in here, which is right here, it wasn't like mega volume. There was some kind of big reversal there. It was just a one-day reversal. So this doesn't count, even on SPY. The target, from a purely technical perspective, not saying it's going to get there, December lows, which is what I've been saying to watch for. We now have these breakdowns. If I go to a weekly chart, SPY, we close at 275.27, the 50 period, 275.11. So we're 16 cents above it on the weekly basis. If I go to $SPX, you can see we've cleanly broken it. Target, 200 period on the weekly on the SPX, which is sort of down near those lows, 2400, 2450. That's a long way down. And on SPY, the target, the 200-day here, the 200 period is going to come in with these lows right around 240. So 30 bucks or so, 35 bucks lower would be the target. That's a lot on the SPY. How about the Qs? We'll start out on the weekly. The Qs closed at 173.95. The 50-day or the 50 period on the weeklies is 173.94. 9.2. It's essentially the same thing if you round it up. But given how the SPY is breaking down, it's going to be hard for the Qs, to hold up in any big way. If we go to the Qs on a daily chart, just go 1 year daily, they closed at 95. The 200 periods at 173.80, 15 cents above. If I go to the Dow, again, daily chart, remember we talked about this in the weekly videos. We closed below Wednesday. Thursday was just a doji. Friday closed near the lows of the day. We've already taken out those March lows. Where's the next technical stop for the Dow? Down here, 217, 218. If I go weeklies, because we like to compare time frames to see if there's still a little hope like we did last week. If you were bull, that maybe things could hang in there. Right through it, closed at the lows for the week. Target now is 220. It's about $28 in the Dow, or $28 in the DIA, the Dow ETF, or 2,800 points on the Dow itself. If I look at the IWM, which is the Russell on the weekly, Russell 2000, small caps, we talked about them breaking down. This little low was maybe the last hope. Well, that didn't last. Target 135 and then down to the December lows. If we do a daily of the Russell, again, let me zoom in here. We started breaking all these moving averages. We came back up, hit them, could not close above them, and now down we go. We took out the previous lows in March, target down here, mid-120s. So bearish across the board, and here's one thing to watch. If I go to XRT, which is the retail ETF, not saying, they're not the same, but remember the December bottom. This was a nice formation here, reversal formation. We come up, we come down, we come up, can't break the 200-day in purple, and then we start rolling over. And I said, as we started rolling over, the target we back down here at the December lows. We're almost there now. We're only 2 points away, which is about 5%. If everything else holds up, this is why I'm saying the other indexes, when we look at SPY, it's just not looking good right now. Sure, there's a lot more distance to go, and things could change. Now, whether the headlines are going to be tariffs or this or that, who knows? I'd prefer to trade what you see, not what you think. Otherwise, you can get in a lot of trouble, aka lose a lot of money. You start getting hung up on opinions. Now, with that said, check out Google. Google's in the news this weekend because, let me bring in the article. I read this on Zero Hedge, also on thestreet.com, that the DOJ is going after Google. They're going to launch a anti-monopoly probe. And after reading the article here, it seems that software as a service, SaaS, is potentially the target. Who knows? We'll just have to see where it goes. But this could, this could weigh heavy on the markets. We will see. Elizabeth Warren has also been targeting them as well, plus some other people, But if it's Google, it could be Facebook, it could be Microsoft, it could be others. We have to wait and see and how all this plays out. But given I'm recording this video at around 10:30 a.m. Eastern on Sunday, June 2nd, the markets really aren't going to open until 8 hours from now. So we'll see if there's going to be a sell-off or not. Then come Monday morning, it could be a reversal. Don't know. This could be stock specific, just a few of these big monopolies, if you will. Maybe the rest of the market is just fine. But again, we trade what we see, not what we think. I prefer that motto. And if you look at Google and that gap down, it's never regained the red line. And I think the red line, the 20-day EMA, is a good litmus test for shorter term momentum because it's 20 days worth of data. Now you can argue that maybe a 30 or a SMA or something slightly different could work, and that's all fine. But my favorite shorter term indicator, bullish bearish, is the red line, the 20-day. And once we got below it on earnings, we could never regain it. And now we're just moving lower, lower, lower. So if I had a protective put in place here, this little sucker would still be on. The target for Google on a pure technical basis is a little bit of a gray area. It's somewhere here. That's a big range. It's about $75 or so, maybe even $100 because of all this chop and basing. So somewhere between, I would say, ballpark 1075 all the way down towards 1,000, maybe just sub 1,000. It only closed 2 days below 1,000, and then it quickly rebounded. Another reason why puts for earnings are so worth considering. Okay, let's go look at some other stocks like Apple. It's always one a lot of folks follow. Company gap below moving averages, tried to rally into the 200-day in purple, moving lower. There's some support here at 170, about $5 lower, give or take a buck, right? Because there's all these little bars, but ballpark 170 below there, and gap filled to earnings around 155, and then back down to the December lows. Apple still remains bearish. Looking at a stock that was actually doing well, Dollar Tree is up on earnings. They closed back above the red line, that short-term moving average. However, volume wasn't that great, but if you're looking for a bullish stock, maybe this is something to consider. We close near the highs of the day. The 50-day will be a litmus test. Above the 50-day, then the previous highs would be on the docket as a target. VMW, which is VMware. Another reason earnings are so important. Stock started to sell off ahead of earnings. That's why considering a protective put just a couple days before earnings is always good too. We then gap lower. Target, there's not much of, this wasn't really much of a pause, and there wasn't a big volume to try to say it was a big battle that was being waged. So the target, 200-day, right around 150, $26 lower. Now, how about metals? Gold, silver, and the miners. Gold and silver, very bullish January, February. Gold, January, and February, traditionally. Miners usually come along for the ride. The rest of the year, not so much. Q3, Q4 sell-offs on gold are common from a seasonality perspective. Right now, what do we have? Well, we had the January, February rise, 6 for 6 straight years in a row, and then it starts to peter out. Well, we had a big move with the markets rolling over on Friday. Volume was bigger. Right now, the target would be 125, 127, but one day does not necessarily a new trend make, so to speak, in terms of maybe a massive reversal here. It's one day target up there. I would say 127. It's only like $4 higher. If I take you out 5 years on gold, now this is going to be a weekly chart, you can see there's all kinds of chop. Before gold would start getting major attention, it would probably need to take out 130. So yeah, it's a one-day move. I'll highlight it for you guys because we haven't talked about gold in a while, But this, with the volume, it's decent. Maybe I could consider some bull puts down here, 30, 45 days out in time. How about GDX, or actually SLV? Let's just look at the other metal. Silver didn't do much of anything. Essentially, it barely moved at all. With silver not coming with gold, it just shows the divergence. And that usually is bad for any continued momentum. You want silver equal or outperforming gold, generally speaking, and it's just not doing it. And we've been saying that now literally for years. It generally is not outperforming gold, and what has happened? Gold goes nowhere in the longer term. Now, let's look at the gold miners. Nice pub, 83 plus million shares, closed above the 50-day. There's chop from 22 to 23.50, about $1.50 range. That would be your target. Again, it's not overly attractive, I think, from a reward to risk perspective, but it's something. Look how it was just clinging to the 200-day, a little below, back above, a little below, back above. This was a bear flag. It never came out where it dropped. Now it pops. Bear flag is negated. Now you just go back up to the most recent swing high area, which is a double top, 23.35 or something like that. So if I had to pick a long call or project, or maybe a bull put, I think I might like bull puts if I could get some credit down here below that support level. Just my personal opinion. Consider if I want to be bullish. Now, how about GDXJ, the junior miners? Also had a nice pop, big volume, got above the 200-day, not the 50. If they get above the 50-day in orange, then the target, again, 31-ish, 33, 34, it's sort of choppy. If I had to pick one or the other, I'd go bull put here too if it was me. And upside targets, it's sort of hard. There's a lot of chop here. I guess the biggest one would be up there about 33.5, maybe 10% up. But given the chop zone at 31 already, I just don't like the reward to risk ratio. Now, one miner in particular, Newmont, it lacked a big volume, but it did have a nice pop. And there's nothing, this was a straight down drop. So 36 the target, 10% higher. Again, not loving it. SIL, the silver mining ETF, not a whole lot of volume. Now, all things are relative. You might say, hey, 180,000 shares is really nothing. In the grand scheme of things, I would agree. However, it is sort of barely above average, but it's just not enough. Target, look where the 200-day in purple and the 50-day in orange are sort of coagulating right there around 2460, 2470, $1.50 higher we get above there. Then you have this 26 to 28 range. Across the board, just not that exciting. So to recap, with Google in the news this weekend, we'll see how that plays out for Monday. Could be a non-event, could be a big event, don't know. But you know what? It doesn't matter. Across the board, indexes are breaking support on ETFs, on the main indexes themselves. The targets are way, way off here. So absolute caution is warranted. Bears have gained the edge. I look forward to seeing you in tomorrow's video. Wish you guys all the very best. Take good care.